Hello friends, welcome to AARDHA. In this video of personal banking, we will go through micro insurance and Atal Pension Yojana. See, now let's see what micro insurance is. Basically, micro insurance is low cost insurance for low income groups covering life, accident or disability. These insurance are regulated by IRDAI. This is the Insurance Regulatory and Development Authority of India. These insurance targeted at daily wage workers, farmers and informal sector employees. Premium is very low. It ranges from 20 to 438 depending on scheme. This 20 is for personal accident scheme and this 430 is for life insurance scheme. These insurance are provided by LIC, public insurances and banks via bank insurance. First, let's see what is PMJJBY. This is Pradhan Mantri Jeevan Jyoti Bima Yojana. As name suggests, Jeevan Jyoti, right? This is life insurance scheme. Here, death due to any cause is covered. Sum assured is 2 lakhs. Eligibility is 18 to 50 years. Here, entry should be 18 and before 50 years. But coverage will be given up to 55 years. Please make a note of this. Annual premium is 438 per year, which is auto debited from savings account. Every year, it renews in May. So, you need to maintain balance in May so that scheme doesn't get lapsed. Now let's see about accidental insurance scheme, that is Pradhan Mantri Suraksha Bima Yojana. Here accidental insurance up to 2 lakhs is given for death or full disability. Meaning if a person is dead, 2 lakhs will be given to nominee, or full disability like 2 legs, 2 hands, eyes are lost, then 2 lakhs will be given. If partial disability means 1 hand or 1 leg, such disability occurs, 1 lakh will be given to the account holder. Here eligibility ranges from 18 to 70 years. Annual premium is very low. This is as low as 20. This premium is also auto debited in every May, so you must keep sufficient balance in the account. Now let's see about Atal Pension Yojana. Basically, this is a pension scheme, not insurance scheme. This is regulated by Pension Fund Regulatory Development Authority of India. This pension scheme is for unorganized sector workers regulated by PFRDA. Entry age should be between 18 to 40 years. Contribution per month is 42 for the 18-year person. If 40-year person joins, it will be from 1454 based on age and desired pension. See, this pension contribution depends on based on age and also desired pension. If 18-year person subscribes for 1000 rupees pension, then 42 rupees is the premium. If 40 years person subscribes for 5000 rupees, then 1454 is the monthly premium. So premium varies from 42 to 1454. Pension amount is from 1000 or 2 or 3 or 4 or 5000. This should be chosen by the account holder. This will be given after 60 years. Actually, when the scheme was started, government co-contribution was given for eligible joiners in the beginning years. Now it is not there. See, very important caution is missed payments attract penalties. Like if you did not pay the premium for few months, then you need to pay penalty also. Also, other important thing regarding this is people are feeling that after paying up to 60 years, I am getting just 1000 or 2000 extra pension. What is the use of this? See, you need to know that lump sum amount, lump sum corpus will also be given at the end. For 1000 rupees pension scheme, 1.70 lakh lump sum is given at the end to the nominee. Also for 5000 it is 8.50 lakh lump sum amount. So lump sum is huge, right? So this scheme is little attractive given the lump sum amounts. Now let's see what is bank insurance and common risks. Bank insurance is bank selling insurance or pension products. Benefit is a customer can get access to these through the bank very easily, but risk is mis-selling by bank staff due to sales targets. So verify details and ensure you need the product before purchasing. Also, very important cautions, micro insurance is not very huge, right? So coverage is minimal. And also in the renewal month, maintain sufficient balance. Also see that you give proper nominee details as per your requirement. Also APY should complement with other long-term savings like PPF or NPS, because in APS you are getting a lower pension, right? So if you opt for NPS, you can get more pension. Don't rely solely on micro insurance for family protection. See what's the call to action. Please let me know new learnings, or if you have any suggestions or doubts in the comment section. And in next week we will learn about remittances. What's the difference between NEFT, RTGS, IMPS, etc. Thank you.